Hello and welcome to our second video and first chapter, Sharpe ratio and turnover. So the question we're going to ask today is, how do we evaluate a trading strategy? So the first thing we might think we want to optimize when we have a trading strategy is the expected amount of money that we're going to make. And that's not a bad place to start, but the expectation is only one value. So we know there's some potential uncertainty in the returns we're going to generate from our strategy, just due to the randomness in the markets. So if we think about our strategy's return as a random variable, then we don't just want to measure the expected value that comes back from the strategy, but we also want to measure the uncertainty or the risk associated with the strategy. So strategies are not just measured in terms of their returns, but they're also measured in their returns per unit of investor risk. And this is really what the Sharpe ratio is. It's a measure of how much money do I expect to make per unit of risk that I take. So how do we measure risk? So that's a good question, and there are many different measures out there. But one thing we can do is just simply take the historical standard deviation of our strategy's return. So how much did that return vary historically? And take that as a measure of the risk. So now taking risk into the equation, we get a more nuanced picture. So here's a simple 2x2 diagram to make the point. So we might have a strategy which has a high expected return, but also a high level of risk. And that's okay, but it's not great. We may have a strategy with a low expected return and a high level of risk. That's definitely bad. Or what about a strategy with a low expected return and a low risk? Well, that's actually okay, as we'll see in a minute. But the best thing we could hope for is a strategy with a high expected return and a low level of risk. And what the Sharpe ratio is it's essentially the ratio of the expected return over the expected risk. So using leverage, hedge fund managers can target a fixed level of risk. So what they can do is they can borrow money from the bank to scale up a low risk position into a position with more risk. So for example, a manager may target a 20% annualized volatility on his underlying capital. So if there's only a 10% risk, he can maybe borrow more money to scale up to 20% annualized volatility. So this scales up the returns and gives a boost to low risk strategies because of this extra capital that can be deployed into them. And it penalizes the high risk strategies. And as I said, to simplify the picture of this risk and reward, hedge fund managers use a single metric, which is the Sharpe ratio, essentially the reward divided by the risk. So if we let X be a strategy with historical daily returns μx and standard deviation sigma x, the yearly numbers based off 252 trading days are modeled by the annualized expected return is 252 times the daily return, and the annualized volatility is the square root of 252 times the daily standard deviation. And the Sharpe ratio equals the yearly return divided by the yearly risk. So as I said, it's kind of like reward divided by risk, greed divided by fear. So let's now look at the Sharpe ratio for a strategy that holds gold futures from 2002 to 2010. So this is just a single trade to buy gold futures and then hold on to them for 8 years and then sell them back. So it's a pretty simple strategy, but the Sharpe ratio, as we know, is computed by the square root of 252 times the average daily return divided by the standard deviation of the daily return. So if I compute my daily returns for my gold futures, here I'm taking the data from the gold table where the date is within 2002 to 2010, computing the percentage return, then the Sharpe ratio is almost equal to 1. So if I take the Sharpe of my daily returns, I see that I get almost 1. And in some sense, you may say that that's not the highest Sharpe ratio in the world, but it's actually really good. And I'm going to explain why that's a good Sharpe ratio in the next slide. What is a good value for the Sharpe ratio really depends upon another factor, and that factor is the turnover. So the primary answer to the question of what is a good value to the Sharpe ratio is based on the second metric, the turnover. So turnover is a measure of the amount of trading that needs to be done to finance a strategy. So the problem is that every time we make a trade with a counterparty or a bank, they'll generally take some percentage of our capital to make that trade. So a high turnover where there's a lot of interacting with counterparties is generally not good. For a strategy X that trades at most once a day, we can define the turnover of a portfolio of assets to be the fraction of assets that were traded. We'll have long and short positions. We can normalize things to compute the turnover as follows. And the reason the turnover is a good measure of the amount of trading, the reason the turnover is a good measure is that it tells us the amount of trading we need to do to finance the strategy. The prices that we're offered to buy and sell at are based on the bid-ask spread in the market. So there's some difference between the price at which we can buy and sell, and hence there's some cost of doing the trades. In an ideal world, we would have a high Sharpe ratio and a low turnover. It's hard to make a rule of thumb, but a strategy that turns over about 10 times a year, I'd say you probably need to have a Sharpe ratio of around about 2 or above. But for our original strategy of holding gold for 8 years, there was no internal turnover, so we weren't going and making a lot of trades, and that's why a strategy of a Sharpe ratio of 1 is actually pretty good for this strategy which just held gold futures. Okay, so to finish up, we've got some multiple choice questions. Thanks for listening. Bye.